The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Welcome to the Accunet Mortgage and Realty Show. I'm Mark Segrist, along with Accunet Mortgage and Accunet Realty Advisors, owner Brian Wickert, and Chief Millennial Loan Consultant David Wickert. Guys, it's great to be with you as always.
And the world looks anew. Last time we were on the air, the Packers had a chance at the playoffs, but
no longer.
Yeah.
So it's a new day.
Sad face.
That's right.
But the world looks anew as well, or again, because Congress passed a new tax bill, and we wanted to hop on the air and talk about how that does, or in my opinion, does not impact home owners and home buyers in 2019
and beyond. It starts right away. So, there was a lot of hand-wringing and consternation and weeping and gnashing of teeth on the part of our friends in the Realtors Association and the home builders that this was going to be disastrous for the housing market, and home values are going to plummet because of the restrictions on deductions for mortgage interest and property taxes. David and I are of the same opinion. That ain't going to happen. Everything's going to be just fine. But let's kind of unwrap and unpeel that onion and talk about exactly what the changes are going forward. And first of all, have you been able to confirm, David, because I have not had the time to do the research, is the new $750,000 mortgage amount limit retroactive, or is that only on a go-forward basis? I am going to go with that's only on a go-forward basis.
The answer is I'm going to go with you.
Okay, so we'll confirm that maybe in a later segment of the show when we're after a break. But so the basics are that in the past, you could deduct the mortgage interest on loan balances up to $1.1 million.
That's a lot of mortgage.
That's a lot of mortgage. And that was $1 million of money you use to buy a home, and that's called home acquisition debt. And then the other $100,000 was for home equity debt, meaning, hey, I bought the house, and later on I took out a home equity line of credit to pay for my car or my kid's education. Fine, you can deduct the interest on up to $100,000 of that home equity debt. Now the new limits going forward are $750,000.
That's still a big mortgage.
Exactly, right. So that's why we're saying it's not much of a change, right? Because there are not too many people out there with a $750,000 mortgage. But the other big change is home equity debt, no longer tax deductible at all. So if you're thinking, hey, I'm living high on the hog, and I'm paying interest now going forward on my home equity line of credit, I do not think that is going to be tax deductible any longer. All right, what else?
I think the charge against the new tax bill focuses on the standard deduction, because for everybody it's basically doubling. So your standard deduction for being single was $6,350. That is now going to essentially double to $12,000. If you're married filing jointly, it's going from $12,700 to $24,000. The only benefit to itemizing your deductions, if you're married, is if you have $24,001.
That's right.
In mortgage interest, state and local taxes, charitable contributions, property taxes.
That's right.
That is not a lot of people.
That's correct. And so you've got to really sit down, and you've always had to do this. This is nothing new, Mark. A person preparing their taxes, whether they did it with online software or they went to a tax preparation firm or they did it with a paper and pencil, you have to sit down and figure out, am I better off taking the layup? The government says, you know what? You can reduce the income on which we're going to assess income tax, and you don't have to document anything. Just take the standard deduction, right? You don't have to produce any evidence to back that up. Or do you want to provide the evidence? So, well, here's how much I paid in mortgage interest. Here's how much I gave away to charities. Here's how much I paid in state income tax. Here's how much I paid in property taxes. Which one's a bigger number? All right? That's always been the exercise. The only thing that's changed now is the comparative number for the layup. The standard deduction is now quite large.
The other thing that is staying the same is capital gains on selling your home.
Okay.
Remains the same. If you're single, $250,000 you can clear, and no capital gains tax on that. married, you can clear $500,000.
All right, that again covers most people do not
Right.
make more than $500,000 when they sell their home.
But to bring this home, the number of people who call into our office every day and say, I want to buy a house. Oh, and by the way, what are the tax implications for me buying the home? Is -2%.
-2%.
Again, it comes down to the property. They're interested in the house.
Correct.
That's right. They want to move. They want to buy that home because they're having a family or they're tired of renting. That's the number one reason for first-time home buyers. I'm tired of renting. And so when we come back, let's talk a little bit about the property tax implication that goes along. There is a cap on that. We'll cover that when we come back.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Joined as always by Brian and David Wickert. And gentlemen, I think before you left for break, you were talking about the potential for the new tax bill to impact mortgage interest rate deduction. And you've during the break, you discovered what the deal really is.
Yep, indeed. The $750,000 limit. So you can only deduct the interest on $750,000
big
of
mortgage
home acquisition debt, and the cutoff date or the effective date of that new lower limit, because the old one was $1 million, is December 15th, 2017. So you can't go out and close on $1 million loan here before the end of the year. You're only going to be, if you did that, first of all, call us. We'd love to do your loan. Secondly,
but it's forward. Forward.
It is forward. Well, and it's actually, even if you close the loan on December 16th for $1 million, you'd only be able to deduct the interest you paid on the first $750.
Okay.
So it is actually a little backward reaching.
Okay.
Into the middle of December. So there's that. Now the other thing we want to talk about is the limit under the new tax bill on SALT. What's SALT, David?
State and local taxes.
Which include?
Property taxes
and
state income tax.
That's right. And if you're unlucky,
which is higher on the coast, which I think was the whole point on.
Right. And some states and municipalities, like Philadelphia, has a municipal income tax. Wouldn't that be lovely to live there? But at any rate, here's something that most people walking around don't know. For income between about $29,500 and $325,000, if you're a Wisconsin resident, you are paying tax at the rate of 6.27%. All right, so quick math, if you're making $50,000 in taxable income, your state income tax that you pay during the course of the year is about $3,000, just in rough numbers. You're paying about $3,000 in state income tax. That's still deductible. All right? And then if you pay $6,000 in property taxes, 3 plus 6 is 9, you're under the $10,000 limit. The people who are going to lose out are the high-income earners who have expensive property taxes. Because if you pay $100,000 in state income tax and you pay, 12, anything, above that in property tax, too bad. You only get to deduct $10,000. So again, for your average person walking down the street, you're still going to get to, take those deductions, but that's not adding up to more than $12,000 for the single person.
Right.
Or remember, we talked about the layup. Hey, which one is higher? This or that? That is $12,000. So the only way you actually get above that is with charitable contributions.
Right.
All right. So you have to. The max you can have in the usual deductions are state income tax and property tax capped at 10. So how do you get over $24,000? Well, you got to give $14,001 to charities,
just to make it worth it to itemize.
Make it worth it to itemize. Okay. Oh wait, you can throw the mortgage interest in
there too. Okay.
How much mortgage interest do you pay on a $200,000 loan at 3.99%, David? You said
the first
it was
year, $7,916.
All right, so I apologize. That also counts towards the limit. So it's property taxes, state income taxes. If you're a homeowner, I think a lot of people are going to get to the $10,000 max. Cool. Then you get to add on to that charitable contributions and mortgage interest. You add those 4 things up. If you're married and it totals more than 24, hey, you're still an itemizer. Otherwise, you might as well be a renter.
Yeah.
And that's what
guys,
the realtor.
Yeah.
Even though you're not required by the government under certain conditions not to itemize and show proof, You better keep your files in order, right?
Absolutely. That's right.
Yeah.
That's not an endorsement of don't worry about it. Have your records.
Correct. And that's why mortgage lenders, send out the 1098 interest statement. That's your proof that here's how much I paid. That's why you get a paid receipt on your property taxes. Same thing with charities.
Yes, sir.
You got to have documentation for all of that. We'll have Cousin Paul on the show.
Okay.
My Cousin Paul, owner of Accunet.
Okay.
No coincidence there. I swear I didn't borrow his idea from his father-in-law's company when he bought it. Accunet. It sounded good to me. And we can have him on the show as we get closer to tax time, as we have in the past. Very interesting stuff. All right, so there's your tax bill as it applies to homeowners in a nutshell.
You got it.
And we're saying overall it is not going to impede people from buying houses. It will change the way you file your tax return. And then the other thing, though, that people have to get their mind around is the percentage of tax that we all pay on our taxable income is changing.
Right.
And so I think until you do your taxes for the first time, it's really not going to hit home, and you're not going to be able to figure out whether this was a good thing or a bad thing for you as an individual. Although I was shocked to see last week that all these big companies, as soon as the tax bill passed, like AT&T and a few others, we're giving out $1,000 bonuses to people as soon as the president signs the tax law. Did you see that?
Yes.
That's amazing. AT&T has 200,000 employees. Times $1,000, that is $200 million that they're going to be writing checks for. Did I do the math right there, David?
We'll double check that.
Yeah, I'm 99% sure I was right
A
on
clear
that.
statement from corporate America on that.
Yeah. Oh, yeah. Big endorsement on that. All right, what are we going to talk about when we come back?
This is a segue. I have a home buyer who's buying their second home and want to talk about just the cost-benefit analysis of putting more down payment down and how mortgage interest did not come up in the conversation.
All right.
We'll talk about that when we come back from this break.
And you're listening to the Accunet Mortgage and Realty Show right here on WTMJ.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
You're listening to the Accunet Mortgage and Realty Show on WTMJ. Once again, we're joined by Brian and David Wickert. Gentlemen.
All right, so I'm going to segue on the mortgage interest deduction and the shrill response that somehow the new tax bill is going to impede home buyers from wanting to buy their next home, because I've got a home buyer who is buying their next home. So they currently own their home. Man, they're going to go buy their $550,000 forever home.
Okay. What's their motivation?
A young child, and perhaps one or two more on the way. Need a little bit more space.
All right.
Trying to get, go from the Tosa to the burbs kind of thing.
Gotcha.
And a young couple, smart, president of a local company. Do you want to ask me how many times did mortgage interest deduction come up in our conversation?
I'll let Mark ask that
Mark,
question.
any guesses on how many times did he ask about the deductibility of his mortgage interest?
I'm sure there were a few repeats, right?
Yeah, no, zero. So zero times.
Really?
And this guy's buying a $500,000 house.
That's right.
So that is my response to that is a reason why people buy houses, because it's not.
Right.
Okay.
And I don't think we're going to see appraisers, by the way, now all of a sudden marking down the values of homes because of the tax deductible. But people aren't going to be writing off their interest anymore. But go on.
So anyway, okay.
So what questions were they asking?
Well, but this piggybacks off of when we last did our show talking about, hey, if you had cash, would you plunk it all down to buy your home? And so for these folks, hey, when you get up into the $500,000 bracket, okay, $550,000 purchase price, they had the 110.
Oh, they have the 20% down.
To put the 20% down.
Okay, wow, that's impressive.
Well, but just walk through the balancing act of, okay, what makes it worth it? For every dollar more you put down, how much does that reduce your payment? Because Accunet, we have a product now where we can do 10% down on a jumbo loan. The new limit, I think this came out in the last couple of weeks, for conventional loans is $453,100. Had to fit in that last $100.
That's right. $453,100 is the new Fannie Mae Freddie Mac limit, which means normal financing.
Normal. Mm-hmm. So for these folks, talked about, hey, what is the benefit of putting 10% down? Because we can do that because they're going to be in jumbo land. So did the math for them. For every $10,000 more that they would put down beyond 10%, $55,000, their payment would only go down $48.47.
That's it.
Yeah.
That's it.
And so for a young couple, kid, 1-2 more kids on the way, what matters more to you?
Saving for
$10,000 or $48 a month? And just if they did the full 20%, which means they parted with the other $55,000.
Right.
Their payment would only change $267.
Okay. So for a dual income family, that's doing all right, they can afford the higher payment. So this is a matter of,
correct.
So what do we do every day at Accunet Mortgage? We lay out side-by-side choices. We accept people from wherever they are. Hey, I want to put $20,000 down, or 20% down rather, and buy this house. Yeah. Great. Let me show you what that looks like. But then what we're really good at is saying, you might want to consider this other alternative for these other reasons. And we point out facts to people that they wouldn't discover on their own. We take a very educational approach to mortgage lending, and it's a big number. I mean, think about it. We're talking about, something that's probably bigger than a person's, at this age, 401k, right? They're going to borrow $400,000 or $450,000. We are swinging a big stick. And so we take that very seriously and think that we really help people make their decisions with their eyes wide open.
I note on the phone and in other talking to other loan consultants that it's hard to unring the bell when you make a large down payment.
Yeah.
As I say, you can't walk up to the wall and pull a $100 bill out of the 2x4s.
You can. It's called a home equity line of credit or a home equity loan. But guess what? Now, that's definitely not tax deductible.
Well, but also you're paying interest on something that could have sat in your bank account at 0%.
All right.
And so it's to say, what is the cost benefit of putting that money into your home?
And you just quantified it.
Right.
$48 for every 10 grand. I have a question for you.
Yes.
Did they need to sell their existing home in order to qualify for the new home?
No. And we did that math.
Okay.
For them, so they fit in the box.
And that's critical. I just recorded our new 60-second commercials for this next week. And so inventory is still tight. We'll talk about that a little bit later in the show. Home inventory is still, I said, tight as the lid on a pickle jar, which, can be almost impossible to unscrew, but it's not that bad. So it's almost as tight as the lid on a pickle jar. And so when you're going to buy that next house, the kiss of death, or the wet blanket, if you will, if you're the person examining competing offers, if one of them has a sale of home contingency,
right,
that goes right to the bottom of the pile.
Because you're waiting for your buyer's buyer.
That's right. That's an uncontrollable factor. So we happen to have access to a product called a bridge loan, and I think we should talk about that in our next segment, because it's not financing to buy a bridge. It's a transitional mortgage product that helps you get from owning one house to owning the next house. And there are many different kinds of bridge loans out there. We have a really special kind of bridge loan that works in a lot of circumstances. People really like it, and we're going to give you the details after this next break.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
As always, joined by Brian and David Wickert. And, I've had the pleasure of following you guys, being part of your team now for several weeks, and a couple of points are really hitting home to me. One of them being full disclosure on the part of potential clients coming to you and just letting you know where they are, not only financially, but where their future plans are in terms of employment engagement, careers, whatever, is important, if for no other reason, for you guys to research the options for the family that really wants to move forward with the property. And the other point being, in many cases, there really are alternatives available to people, regardless of their wealth or lack of it, or status in life.
That's absolutely right. We have to do good fact finding, kind of like going to the doctor. We need all the facts. We need your blood pressure. We need a blood test. We have to do other weight, height, all that kind of stuff. And so we do have an interview process that's standardized to help uncover that. But it does help to also have a frank conversation about, what are your immediate goals?
Right.
So if somebody does,
we're not trying to be life coaches, but we're trying. What do you want life to look like?
And I would tell you, the one that I come up with a lot of times is talking with people. One of the standard questions you have to ask is, how old? Do you have any dependents?
Right.
And how old are they? Well, if you have a 4 and a 6-year-old, it's an easy question then to follow up with, how are you doing on college savings?
Right.
And they might say, no problem.
What is that? Or haven't thought of it.
Right. And so then you're talking about, well, hey, you could put down $100,000, right? Or you could only put down 50, like David's couple that he's working with.
Yeah.
And then you know what you could do? You could put the $50,000 in a college savings plan, and we'd introduce them to a financial advisor. But I happen to know from my own life experience that you're not limited to putting $3,000 away for each kid. That just happens to be the maximum that you can then deduct the income tax on. And I don't know if that survived it either, by the way.
Okay.
The new tax bill. But the point being that you can actually put $50,000 in a lump sum into a 529 college savings plan,
which can now be used to pay for elementary and secondary school up to $10,000 a year.
There's a big change. So just by the way, 529 plans used to only be for post-secondary education, colleges, technical schools. Under the new tax plan, as David just pointed out, you can use it to pay to go to Marquette or DSHA or even a elementary school.
Yeah.
You fill in the blank of your favorite parochial school. And so all the more reason to be conscious of what you're using your money for. All right, so before we took the break, I said bridge loans, and we have a special kind of bridge loan. The kind of bridge loan that we have that'll help you buy your next home before selling your old one pays off any mortgages you have on the home already. So if you had a first mortgage on it and you had a home equity line of credit, the bridge loan pays off those mortgages. And the most we can lend you on that bridge loan is 80% of the value of the existing home. David, you look like you have a question.
No. I'm just to clarify, because a bridge loan is meant to be temporary, and so we can only go up to 80%. So you need to owe less than 80% of the value of your home.
That is correct.
Clear anything.
Correct. So it's not a tool that works in every case, but for a lot of move-up buyers, they do have that. Here's the other cool thing about the bridge loan that we have access to. There are no payments. Because I think that's a really concerning thing for a lot of people trying to transition from owning their existing home to buying a new one is, well, I don't know if I can really afford double mortgage payments. Well, on the bridge loan we have access to, there is interest accruing every month. So the interest meter is running, but you don't have to pay it until the end of 6 months. And most people have no problem selling their homes in today's market in less than 6 months.
Especially in our market.
Exactly. Hot market.
Another ding on the mortgage interest deduction not impacting home values. Inventory is tight.
Yeah,
so
that's right. That's right.
I continue to pick on that because it's not, anyway.
So now, how many people, Mark, walking down the street, how many of your friends know anything about bridge loans?
I don't.
Nobody.
Hardly any.
Why would they?
It's probably a tool within professional circles that you're aware of.
That's right.
But the average potential homeowner probably has no idea it even exists.
Now, we do have a client that David and I are both working with that we're going to talk about when we come back, where we don't have a solution for them. A bridge loan wasn't a possibility because they don't have as much equity. So let's talk about their situation. Because it's a real-life situation that they've struggled with for, I think, almost 9 months.
Oh, wow. Okay.
Or the better part of a year.
Yeah.
And we'll give you that story when we come back.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Once again, we're joined by Brian and David Wickert. You had a couple in mind that there's a story that kind of surfaced in your mind about a couple that you've been helping.
Right, because we have a lot of tools in our toolkit, and we can help almost everybody, but this particular couple didn't have enough equity in their existing home.
I think they had 5 or 10% equity.
Right, so minimal equity, so a bridge loan wouldn't work, and yet we could,
we got them rock solid.
We did. We gave them a rock-solid guaranteed pre-approval, but it was contingent upon them selling their existing home.
Yeah.
And so they have been out looking for homes for over 6 months.
Oh, in what market? Tosa.
Oh, in Tosa.
Yeah.
Okay. And writing offers over the asking price. But do we have them approved with 3% down or 5%?
We went to 5%.
Okay, so we did upgrade it to 5% down. But again, if you're even with a rock-solid guaranteed pre-approval from Accunet, which is the strongest pre-approval you can get in the market, we say if we fail to make good on this pre-approval, we will write a check for $1,000 American dollars to not only the buyer, but to the seller. to say, man, we made a mistake. Mr. Seller, you relied on our rock solid pre-approval letter, and we weren't able to deliver those terms, so our bad, here's $1,000. We're really sorry. Nobody else does that. Nobody else puts their money where their mouth is. We are doing that a lot, and it's working.
Yes.
But if you're a seller in Tosa and you go, okay, here's an offer that I got from somebody with 5% down, they're offering me $2,000 more than asking. That's our buyer, right? And then you got somebody else who's at $1,000 over asking price, and they're putting 20% down. The sellers, 99 times out of 100, are going to go with the bigger down payment,
Right?
Because it just is emotionally safer for them.
Well, and you're communicating that you got a little bit of wiggle room on getting her done when you're putting 20% down.
That's right. If the appraisal comes in low, okay, maybe I can still, make good on my financing because I could still buy it with 18% down instead of 20,
Right.
something like that. So these folks are finally gotten frustrated enough, and sometimes that just takes real world, experience.
Losing one or two?
Where, because what they wanted to avoid was the double move. If you go and sell your house first, okay, you got to go move to an apartment for at least 6 months, typically, before you can then go month to month, right? And so they're finally, I think, capitulating, I believe, is the official economic term.
Wow.
And realizing they're going to have to sell and then become, like first-time home buyers again, which is great because then they aren't going to have
uninhibited
home contingency.
Yeah.
Right. Okay. That was a big problem for them. All right, so what about rates, David? Where are we with rates right now here?
Funny you should ask that. So since last time we were on, the Fed raised rates for that third time here in 2017.
That's right, and the immediate impact of that, right after they did that on December 13th, oddly enough, was that 30-year fixed rates dipped very unexpectedly.
Yeah.
Okay? But now in the intervening week, things have started to creep back up.
Well, and they said, hey, we're going to try to raise rates 3 more times in 2018 as well.
Right.
I looked, March of 2018, 50-50 shot, they're going to raise rates another quarter.
Okay.
So that's going to be here in 90 days.
Yep. And just as a reminder to everybody, when the Fed raises rates, they're raising the rate that banks charge each other overnight. It's called the Fed funds rate, to park money in each other's banks. Or at the Federal Reserve, I should say.
Yes.
Then the rate that impacts right away is the prime rate.
I use Mint. I got 2 notifications right away that, hey, the APR on your credit cards have changed.
Oh, instantly.
Oh, yeah. I mean, like a week or 2 after, because boom, right away. And same thing with home equity lines of credit.
Okay. Yeah. So home equity line of credit is tied to prime. So that rate now, effective for January 1st, I think of most people's home equity lines of credit, 4.5. If you're at prime plus 0.
Yeah.
And headed, if the Fed makes good on their threats, or their plan, headed to 5.25 by the end of 2018. Well, think about that, Mark. 4.5 on a home equity line of credit, which is variable rate mortgage, or 3.99 on a 30-year fixed.
APR is 4.01.
APR is 4.01. And so right now, at the end of the week, we could do 3.99 with no points, David?
Correct.
$200,000 mortgage with 25% equity and all the other right stuff. A week ago, I was advertising 3.99, not only with no points, but no loan costs whatsoever. So in other words, the closing costs have increased over the last week by about $1,188.
Correct.
Not bad. I mean, in the big scheme of things, that is still super fantastic. And we can still do a no loan cost mortgage. It's just going to be at a slightly higher rate.
Correct.
And so I think what we're seeing people, waking up now and they go, oh yeah, the Fed raised rates. I still have.
It ain't going to get
$50,000.
any cheaper.
No. And so I've got a guy right now who I'm helping, who actually borrowed a large amount. I think it was about $300,000 on a home equity line of credit.
Whoa.
But he did that when the home equity line of credit rate was just 3.25. It was at 3.25 for so long. I think people thought it ain't ever going to change.
Right.
Well, now all of a sudden that's up to 4.5. And he's going, you know what? It's going to go higher. I need to get out of this thing. So we are in the process, and we'll close in early January to pay off that loan and convert it to a good old-fashioned 30-year fixed rate. What do we got in the last segment of the show, David?
We're going to talk about getting pre-approved to buy that house in 2018 and the power of gifts. As you're sitting around the logs on fire at Christmas time, we're going to talk about how to ask for that gift from grandma, grandpa, parent, cousin, whoever that might be, when we come back from this last break.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Don't just find a house. find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
You're listening to the Accunet Mortgage and Realty Show on WTMJ. Once again, we're joined by Brian and David Wickert. And before you gentlemen went to break, you were talking about how, when the family gets together during the holidays, not a bad time to talk investment?
Yeah, well, or, hey, right after you've given that great Christmas sweater to Grandpa for 2018 and beyond, you might look at Grandpa and say, Grandpa, and you know what I would like as a gift for next year? I would like to buy a house. Because at Accunet Mortgage, the second only to having money in your savings account, the best source of down payment is a gift. You can receive a gift from a eligible source, which basically means family member. That could be
or significant other
or fiance. I don't know how we prove that. Do we get a picture of the ring? But anyway, It can be grandma, grandpa, mom, dad, cousin, uncle, sibling, someone who's related to you can provide a gift as part of your down payment.
But now, if you repay that gift, is it still considered a gift?
Well, there can be no requirement to repay the gift. And so we have a standard letter that almost every mortgage lender has the same letter that both parties sign, the donor and the recipient, that says this is a true gift and does not need to be paid back.
But in reality, if one does pay it back, that's okay. We're still
not our
good.
business,
Because that's kind of important, isn't it?
Absolutely. We see that happen all the time. And it's just fine, but there can be no written requirement. Did have a guy actually then behind our back go and record a second mortgage, and we found out about it, and it was fraud. So we threatened to foreclose on him because he committed mortgage fraud.
Awkwardly, we had another person, dad, who didn't want to give a gift anymore to the kids because they didn't like the house they were buying.
Right.
So that's awkward.
So yeah.
But anyway, is he breaking the contract and so doing that?
No.
Okay.
Because it's just he never did sign the gift letter, and it's even not a contract anyway. It's really a representation.
So if all goes well at Christmas and you can get grandma or grandpa or parent to give you a gift as part of buying a house, we can pair that with any savings you can or will bring
to the table
to closing and help you buy a house in 2018. Because I think I've said it's easier to get a $30,000 job than it is to save $30,000.
For sure.
And so if that's the thing that's impeding you, you got great credit because you've been paying things on time. You got a steady job. If the thing that's keeping you from buying a house in 2018 is, I think, how much money do I need
for a down payment?
Well, that answer can be 0 if you have
0% down, 30-year fixed rate loans.
Answer can be 3. Answer might be 5%. It's not 10. It's not 20.
That's right.
And again, kind of Mark to what you said, what we do is we hop on the phone with first-time home buyers or second, third, fourth-time home buyers, and we are mortgage teachers. Go ahead.
To the same to this very topic, I have a couple right now that I'm working with buying their first home, and they are taking money out of a Roth IRA for their down payment, and so we are minimizing that, right? Because when you take money out of retirement, it's no longer growing for the intended purpose which you put there. Now, unfortunately, they don't have a source for a gifted down payment, but there's a perfect example of if you could get a gift from grandma or grandpa or your mom or dad for the down payment rather than taking money out of your retirement account, you would be so much better off. Now, the next thing that usually comes up is people are concerned that, I shouldn't give my son more than $14,000 because then I'm going to have to pay income tax on it. I'm not a tax advisor. You should check with your own tax advisor or IRS.gov. But I happen to know for a fact that if a mom and dad can give $14,000 to their son, the dad can then give $14,000 to his daughter-in-law. The mom can give $14,000 to the son, and the mom can also give $14,000 to the daughter-in-law. That adds up to 14 times 4, $56,000.
That covers a lot of down payments.
That's right. So, in a situation like that, and you can give $56,000 to somebody else and not have to fill out any form with the IRS. And you can even give more than that. We have families that do that all the time. Then you just have to tell the IRS how much you went over the $56,000 limit. And they keep track of it because guess what? It counts against your estate tax, which is now up to how many million?
22.
Yeah, 22 million exemption. Not too many people are going to give that much money anyway. So great time to buy a house. Now, my advice for anybody right now is get your rock solid pre-approval going now. Lay your plans now here. If you've got time off between Christmas and New Year's, let's get started on it now, because I think it's going to be a fast start to the 2018 home buying season.
We have people buying houses already now in January.
Absolutely,
February.
and one reason is no Packer playoff games. That, honest to God, is going to get people out there looking at houses on Sundays, because they're not going to be looking at the Packers. No playoff games. That's all we have time for right now. All you got to do to get started, either to find out how much money you can save with a no Social Security number required refi checkup, or to get started on a rock-solid guaranteed pre-approvals, click on that big blue button at Accunet.com.
And as always, you've been listening to the Accunet Mortgage and Realty Show on WTMJ.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors, and not WTMJ Radio or Scripps Media Incorporated.